Hi, everyone. Welcome to a new series that I'm starting this year, which I'm calling the 2025 Pinescript series. The focus is to develop a series of daily chart strategies, many of which I actually personally trade, in order to level up the community so that you guys have the ability to prove that you have an edge, and then also quantify risk, determine your size and instrument, um, kind of watch it in the live market, either paper trading or sim for a while, just to verify that your strategy uh, does actually perform similarly to your back test, and then from there you can decide whether you want to execute it and monitor it live. And the main reason for this is because I'm a member of many trading communities where I mainly lurk, and I see that most people are not profitable because they're not actually trading with an edge, but they think they have an edge. And so you'll see this all the time where someone talks about how they captured some kind of move, and they're asking like, "Did anyone else capture this? Look at this great move in the market that I caught." And then they might even get a payout if they're doing like a prop firm, but then 6 months down the line they're not there anymore, they're not talking, uh, and you don't hear anything about them, and that could just be because they are either successful or maybe they don't actually have an edge. At the same time, you see a lot of people who are in those communities who trade and are not successful after months and years, but are convinced that they have an edge, even though there's no data to actually back up that they have an edge. So if they're day trading, they never got a payout, but they keep trading and talking as if there's actually an edge in what they're doing, even though the data that they have shows that it's the opposite, that they're actually losing more money, especially if they've never gotten a payout or actually, made any sort of money. Then and so what I'm wanting to do here is give you the tools so that you can actually prove that you have an edge, because again, the number one reason why you can't make money in the market is you don't have an edge. You think you do, or you may not be sure if you have an edge, but without an edge, nothing else matters. Your psychology doesn't matter. Uh, your position sizing doesn't matter. You have to have an edge first to actually make money in the market. So this is where we are. Um, we are all the way down here in the trading strategy development. And this is something I really want to emphasize, is that if you're new to the community, then start with the roadmap at the top. And a lot of people, especially those who've gone through like the American or the European school system, you basically had 2 decades where you were taught to think and live your life in a certain way. And your lifestyle, which I'll call your model of life, is based on that knowledge that you've gained. And it's usually something that allows you to be a functional member of society and a contributing member of society, which is important for the society's survival. But if your goals are to develop financial independence or even leave the what some people call the rat race, then you have to level up your financial game. And the problem is that a lot of people say, okay, I've gone through 2 decades of the school system, I'm educated, uh, all I have to do is find this one thing. And they have heard from some other people that they make money from trading or investing. And so they decide that they're going to expand their life model to include trading or investing. And then they just stop there. And they stop there and they think, I'm just going to make it all from trading, or I'm going to make it, I'm going to achieve my financial dreams with trading. And what happens is that they start equating their financial dreams with trading dreams. It becomes one and the same. Like, my financial goals are my trading goals. And that's just really sad, because when you put all your eggs in one basket, you're unlikely to you're not really diversified. And also, most of us, we don't really reach our goals. Very few of us reach the goals that we've intended. We fall a little bit short. And so if your goal originally was something financial, like financial independence, then you're better off learning multiple ways to earn money and then combine them together, rather than just saying, oh, I'm just going to learn how to trade and that's going to somehow be the only thing I need to do to achieve my goals. And just to put it into perspective, if you're watching this video and you have traded for some time, I want you to ask yourself, how much money did you actually make last year? Because we have some members in the community, and I want to mention that as of the time of filming this video, the community's only been around for 6 months. We have some members in the community that have made 5 figures in 6 months. If you have not made that in trading, then I really think you should ask yourself, what is your life model? What what is your financial spectrum that you're working with? And if you've never heard of the credit card game, of casino churning, of gift card arbitrage, or buying groups, or some of the other things that we might have developed, depending on when you see this video, if the only thing you've heard of is trading, then you are fighting one of the hardest fights in terms of making money. And I firmly believe that trading is easier after you have money. And that's just because a lot of trading is psychological. Some of the other income streams that exist don't have the psychological challenges that trading does. And one of the most popular trading books is Trading in the Zone by Mark Douglas. And in that book, he has a quote that I really like, which is that if you can make yourself independent of the market, then the struggle ceases to exist. I think the actual quote is something like, if you make yourself independent of the movements of the market, then the struggle ceases to exist. And that's a quote that I firmly agree with. It's a lot easier to trade if you're making money from multiple sources of income because a lot of the psychological challenges tend to disappear. And I know that a lot of people say that they don't have psychological challenges, that they don't care about what happens in the market. But then you go look at their trading and you're like, well, clearly you've taken emotional trades or you've lost money or you're not consistently profitable. And so you're just lying to yourself. Like clearly you do care about how the market moves. And you can say all the things, but if you can't walk the walk, then it doesn't matter in the end. So again, if you're new, please follow the roadmap. You will learn so much about finance that you never even knew. And then trading will just be one leg of your financial strategy and not the only thing that you happen to know about. So this series is based on trading. So let's go ahead and talk about something similar, which is the reality of only trading one style. So I was transferred to Charles Schwab from TD Ameritrade somewhere around the middle of last year. So I'm actually, the equity curve here is only about half of last year. And you'll see that somewhere around the end of May over to the end of December, um, I had a rate of return of 73.5%. But believe it or not, I'm actually in a 30% drawdown right now because at one point, if you look at the equity curve, my account was above 100%, which for those who don't know, 100% is basically doubling your account. So um, the reality of trading only one style and trading in general is that the returns are pretty volatile. I have different accounts with different brokers for different trading strategies that I do, and that's largely because like if you're going to trade options and you're selling options, you likely have a margin account, but you may not necessarily want all of your trading brokerage accounts to have margin, and so there's reasons to have different accounts with different brokers. Some also give you better rates for certain option strategies or at least options commissions. And so in terms of what I'm doing for the daily chart strategies that we're going to explore in this series, this is what an equity curve might look like. And this is the reality of trading one type of strategy or one series of one style, I guess, of strategies is that the drawdowns can be volatile and there are going to be times when you question, does my strategy still work? Should I turn the algorithm off? And if there's one takeaway that I can give you, at least from this slide, is that the time when you think you need to turn the algorithm off is probably the time that you need to just push through the mental pain and leave it on, because if your backtest shows that it will recover from those types of drawdowns, then you need to leave the algo on so that it has time to recover, because if you just keep turning it off on all these drawdowns, you won't see the recovery at all. So similar to what I talked about in terms of having multiple streams of income, and I'll have another slide for that as well. Um, you can have multiple ways to trade as well, and that's why people say diversification is the closest thing to the Holy Grail. Part of the reason why I think trading is difficult is because the human brain is not really evolved to easily comprehend or at least piece together the elements that produce a strong equity curve. And so here's a screenshot from one of Kevin Davies' videos. Kevin Davey is a guy who won the Futures Trading World Championship, and he did it with algorithmic strategies, which is what really impressed me. And he also sells his own algorithmic trading course. It's a little pricey, but in my opinion, it's probably the best one out there. And he actually has patented his process, and so the process I'm teaching you is not as good as that, but it's decent. Like if you want to make money and see like the returns that I showed you on the previous slide, then this process that I'm showing you here uh, will work. It's actually a good segue into his process if you decide to buy his course later as well. And that's just because if you're brand new to algo trading, his process might be a lot to take in at first, whereas mine is a little bit easier to comprehend. And so it's easier to start with this and then expand over to his or any other algo trader's course later on. And so here is an example of 5 trading strategies that have significant drawdowns. Ones that if you were just looking at that individual strategy, you might say it's not good enough, I can't trade this. But if you were to put all 5 of those strategies together, you get an equity curve that I think a lot of people would say they're willing to trade. And this is kind of what I mean by the human brain not being evolved to really to be able to easily piece together systems like this. You generally need to have tools to quantify it so that you can see what happens if you to trade like strategy A and strategy B, and also be able to think outside of just individual type strategies and sort of think of your trading system as a whole. And again, this is from Kevin Davies. These screenshots are from Kevin Davies' YouTube channel. I'm not actually affiliated with Kevin Davies, so this is not like a paid recommendation. This is just me speaking honestly. I think he's got possibly the best algo trading course available for. And then similarly to what I talked about on the last slide, this isn't just for trading. The more uncorrelated income streams you have, the smoother the equity curve becomes as a whole. So here's an example of what might happen if you were to take several things in our Discord, several income sources, and combine them together. You get an equity curve similar to this. Now, I was on vacation for 2 weeks in October. That's why there's kind of a gap here where it goes from October 4th to October 19th, but it averages out to about 10,000 a month. And then this year, I'm trying to expand and scale so that this equity curve will, or at least the numbers on the left will be even higher numbers. At least that's the goal. But this is just an example of what we teach in the community. We show multiple ways to make money within different methods of making money, and that might sound like a mouthful, but I'll use trading as an example. These daily chart strategies I'm teaching in this series are a way to trade, but then in the future I'll probably make a series on multi-leg options, and that's another way of making money within trading as well. And so the advantage of all this is you may decide, you know what, I don't like options, and so you'll have different things that you'll have different options to choose from and piece together to hopefully create an equity curve that looks something like this for yourself. Okay, so diving into some of the basic requirements for creating strategies. The first one is that your idea for the edge should be explainable, unless it's some sort of data mine phenomenon. And so the main point is don't try random ideas. Actually be able to have some sort of theory as to why you think that idea should be something you should spend time testing. The thing that you might have heard about algo trading is that you'll probably find one tradable idea out of 100. And so the idea is to iterate faster. And so you don't want to be wasting your time on ideas that just don't make sense, or like that you don't really have some sort of theory or hypothesis as to why it should work. The exception is if you're data mining, which is usually if you're having your computer process tons and tons of market data and just trying to see if there's some sort of pattern between certain movements in the market. And then usually if you've data mined a strategy, then you usually go back and say, okay, maybe I can find reasons to explain why this phenomenon exists. But most of us are not doing that. And so before you start spending time on ideas, you should have a theory as to why that idea should be explored in the first place. The second thing is that you should only have a few rules, and that's just because the more rules there are, the more I guess strict the strategy is. And the problem is that the markets are evolving and changing, and they're never they're never a tight fit to any sort of strategy. And usually I would say strategies should have around 3 to maybe 5 rules at most. Once you start adding too many rules or rules beyond that, usually you're adding those rules because you see some bad trades in your backtest and you're trying to fix your backtest. The problem is that fixing the backtest doesn't mean that you're guaranteed to have better results in the future, or that that rule that you added to remove bad trades in the backtest is actually going to prevent bad trades in the future. And this is typically called overfitting or curve fitting. This is also why if you're not an algo trader and you're trying to buy an algo trading system, they'll probably pull the wool over you or sell you snake oil, because they know the only thing you probably have an idea of is this concept called a back test. And they know that you probably don't understand how backtesting is just one tool within the entire framework of how you develop an algo strategy. And so they might have seen that their strategy that they developed takes a bad trade on like June 4th, 2020, and then they literally put a rule in there saying don't trade on June 4th, 2020, just to get rid of that bad trade during the back test. And so they have this beautiful looking equity curve, and they sell you the strategy, and then you try it, and then it doesn't work, and then it's like, oh, but our return policy was only 20 days, and you've gone outside the window, or some other reason why you can't get your money back. Um, so yeah, just understand what curve fitting overfitting is. The third point is that similar variations of parameters should be viable. So if you're trying to say, like if you're testing a EMA crossover strategy, most common one being when the 5 EMA crosses the 20 EMA, that's like a swing trading strategy. A lot of people will look for a pullback to go long. And if you do something similar, say you take like a 8 EMA crossing, I don't like a 14 EMA, or like a 15 EMA, you should have relatively similar results. If you have drastically different results, then your entire idea for the strategy is more likely to be a coincidence than something that actually is an edge. And the last part is pretty important. You either need to be able to beat buy and hold or have higher risk adjusted return. And so for people that are new to algo trading, it's not enough that the algo happens to make some kind of money. And this is also kind of the joke I see in many trading communities where people get a payout from a prop firm, but they would have actually done better if they had just taken all that money that they spent on buying those accounts and just put it into the index, because by the time they got that payout, uh, that payout minus the expenses for buying all those accounts is actually less than the buy and hold return. And so it didn't financially, it doesn't make sense to for them to be trading at all with these prop firms. Um, but that's typically only true if you have a lot of time in the market. And so if your strategy doesn't trade very often, then I would not be looking at whether it beats buy and hold, but rather whether it has a higher risk adjusted return, meaning for the amount of time in the market, did it have higher gains than the market typically made in that equivalent amount of time. And I typically like strategies that don't trade very often, but have really high risk adjusted return, because that usually means that they are capturing very strong edge, and that because they're not in the market all the time, I can combine them with other strategies that also are capturing some really strong edge. And so that's how you end up with a really strong trading system as a whole, uh, rather than just being locked into the idea of does it beat buy and hold. However, these concepts are both important. You either, if your strategy is in the market a long time, then it should be able to beat buy and hold, and if it's not, then it just needs to have some basically better alpha or higher risk adjusted return than the buy and hold strategy would. So the final thing to mention is that some strategies may have additional requirements just depending on the type of strategy. So for example, mean reversion strategies, we typically like to see them have a high win rate and to have a few, for their drawdowns to be few and far in between, but those drawdowns to generally be pretty large. And then in this series, what we're going to be exploring is ways to capture the bullish bias in the S&P 500. And to do that, we should first start with talking about why there is a bullish bias in the S&P 500. So here, this is a weekly chart of SPY, which I'm using as a proxy for the S&P 500. Typically, when we say S&P 500, we're referring to the SPX cash index, but the ETF is often a good proxy for it. And as you can see, it mostly trends up. There have been some bear markets, but for the most part, you would have made significantly more money if you figured out how to get long rather than trying to figure out how to get short. And so there's several reasons, many more than this, as to why there's a bullish bias in the market. And that's the first one is just because the Fed desires inflation. So when Alexander Hamilton, who's kind of like the forefather of the American economy, when he was designing how the American economy should function, he believed that uh, if inflation is at zero or less, then people with a lot of money would be encouraged to sit on their cash. But by having inflation always be higher than zero, it would encourage those people to invest back into the nation, back into the economy. And so that is why the Fed desires inflation to be above zero. And when there's inflation, that naturally means there's going to be higher prices. And naturally, that means that the index is also going to be trending upward, or at least have some sort of fundamental long bias just as a result of that. Second reason is because when the S&P rebalances, it's trying to capture the 500-ish most influential companies in the United States. It's going to replace weak companies with stronger companies, and so it's replacing stocks that have probably lower market prices with stocks that have higher market prices. And what's that going to do to the S&P 500? Well, it's going to increase the value of the S&P 500 as a whole, and so that's going to cause it to again have more of a long bias. S&P 500 is also not just 500 companies. It's actually around 503 right now, and that's just because it's supposed to be like a proxy of the 500-ish companies that are the major workhorses of the American economy. Um, Other reasons are things like innovation has increased over time, and while news can also drive the market, innovation is generally seen as good for the economy and the market, and so that also introduces a long bias. And then, of course, we've had more jobs and more people since 1993, which is when the SPY came into or was when it existed. And so, more people and more money and more jobs. That generally means there's probably going to be more investors, and more investors means more money going into the market. And generally, when people say they're investing, they're talking about buying and holding or buying some kind of ticker. I don't know that many people who say I'm going to invest, and their idea of invest is shorting the market. There's a reason why it's called buy and hold, not sell and hold. Um, and so typically, you have to be a pretty advanced investor in order to be shorting any kind of stock or ticker for an extended amount of time. And of course, there's many more reasons, but these are just some examples of why there's a bullish bias in the S&P 500. So what we're going to be focusing on in this series is how can we take advantage of this? What are some ideas that we can experiment with? Really, it's not going to be experimenting with ideas. Again, the strategies that I'm going to be teaching you how to code in this series are all strategies that I run personally. And if you're wondering why I would give them away, it's because I don't think they're going to go away, because they're trying to capture the bullish bias in the S&P 500 in a way that beats buy and hold or otherwise has better risk-adjusted return than buy and hold. And so the fundamentals of why the S&P 500 has a bullish bias, those would have to change for these strategies to no longer work. And so I don't care about giving them away. They're actually an edge that most institutions already know about, but the average retail trader may not know about. And so I'm hoping to level up everyone's game by teaching this series and teaching you these strategies. All right, so the strategy that we're going to develop is an end day breakout. So this is just going to look back some n number of days. In this case, we're going to use 10, and it's going to check for a breakout. And one of the things that Perry Kaufman has shown a lot of data and research on is that U.S. equities tend to trend in the long term, but mean revert in the short term. So that's not going to be as important in this first iteration that I'm going to show you, but it's going to be important in the second. So the reason why we care about an end day breakout is because we generally want to avoid taking trades in bear markets, and or at least we don't want to be taking a trade if the market's going down. It's fine to take a trade in bear market actually, and we want to avoid sideways price action. And so one of the best ways to do that is just check, okay, do we have a new breakout, and only enter if we have a new breakout. So that's kind of the idea behind the end day breakout system. The rules, we have an entry condition and an exit condition. And this is partly why algo systems can be very difficult to develop, because you have to get both of these right. If you have a great exit condition that makes sense with the idea you're trying to test, but your entry conditions aren't good, then the algo is not going to test well. At the same time, if you have amazing entry conditions, but your exit condition just doesn't make sense or isn't good, then your strategy also is likely to fail. And so you have to get to these two different variables right, and that's partly why it's difficult to make an algorithmic trading strategy. That plus the fact that your idea has to kind of make sense and has to be supported by these two rules, it's just another factor in there. So the first thing that we are testing is, well, I'll start with the exit condition first, which is that the instrument has to close higher than the previous day's high. And if you just think about a breakout, like that's just what makes sense. If we're trying to catch a breakout to the long side, there's not a breakout if it didn't close higher than the previous day's high. That's not a breakout to me. If it closed lower or it closed around the same value, that just means the market went sideways. So to me, yeah, that makes sense. You know, that you want to come with an exit condition that is like, here's the most simple way to capture what I am trying to do with this strategy. And you can argue, well, if it's going to be a breakout, then maybe it should close higher 2 days in a row. But I have problems with that, because it's very possible that it closes higher, the first day, and then the next day it pulls back a little bit. I mean, I just think when you complicate the exit condition or the entry condition, then it just starts to get unwieldy, because it's not necessarily always true. All these other rules that you're adding to it, it's fine to test them, but you'll find that a lot of times the more rules that you add, the more complex your strategy is getting, and you're also making assumptions about the market, about breakouts in general that aren't necessarily true, especially because uh, U.S. equities tend to mean revert in the short term, and so yeah, I don't think I want to expand too much further than that. Going to the entry condition is just buy when the instrument makes a new end day high, with N being 10 days, and it doesn't necessarily need to close as a new high. We just need to see that it made a new high relative to the high of the past 10 days, because that just means that investors and traders in the market are ready to take the market up, or at least are trying to. And so if we test that, and the coding section is going to be the video after this, but if we just test that idea, we'll find that it doesn't really work, at least not with these rules as written. And you'll see a few metrics here. First is net profit, then you have total closed trades, then percent profitable, and then profit factor, max drawdown, and average trade. So if you don't know anything about algo trading, you're probably going to go straight to net profit, but or percent profitable. I prefer not to look at those as much, except in certain cases, and that's just because net profit tends to go up as the number of trades taken goes up. And so you'll notice that the equity curve itself is mostly flat, except it starts to head up somewhere around trade 755 is whenever it actually looks like a good equity curve. And so the problem with looking at net profit is that the more trades that your strategy takes, assuming that it does generally make money of some kind, uh, the more trades it takes, the higher the net profit. However, that doesn't mean that you have a good trading system, and that's just because if you were just randomly buy the SPY at random times and with no stop loss and just continue to hold, and then exit for arbitrary reasons, like just exit whenever it's higher than your entry price, yeah, you would make money, especially if you traded a lot. But that doesn't mean you have a good trading system. It doesn't mean you're capturing great entries. You're probably buying a lot when the market's just going sideways too, and you're probably just barely scalping out. And so that's where profit factor comes in. Profit factor is it takes all your winning trades and sums up the gains from all your winning trades, and then it sums up all your losses from all your losing trades, and then it divides the sum of all your winning, the sum of all your net profit, basically, or not net profit, the sum of all your profit, your gross profit, divided by the sum of all your gross loss. And so the reason why that's important is that does not care about the order in which things happen. It doesn't care if you had all your losses first, then all your wins. It just takes all the winners and divides it by all the losers. And that tells you how efficient is your trading system. And me personally, I would consider like 1.5 maybe the bare minimum. But I personally would not trade a 1.5 for profit factor system. Max drawdown, I don't think I really need to explain that much. It's, it depends on your risk level of comfort and whatnot. And then of course average trade I think is also important, just because well, your average trade, you generally want to be worth it to actually be trading the system. So unless it's a scalping system, which this is not intended to be a scalping system, your average trade probably should be better than $25. So let's go ahead and go to oh, well, actually, before we move on, I just want to touch on something really quick, which is that this backtest was done from the inception of SPY in 1993. So market conditions have changed since then. There is strong argument as to why you might consider trading this strategy with these rules, because if we were to only backtest like the past 10 years, and I don't actually know, uh, whether it's like trade 755, 784, something in between where the last 10 years actually happens. If you were just to backtest the past 10 years, you might see it's a good equity curve. And there is argument for actually trading the system based on that, because the market fundamentals have changed. The market has shifted. The SPY is not the same as it was 1993, or like from 1993 to 2007. So why do we care that much about backtesting through that period? And this is something where if you're really interested in algo trading and after this series you want to take it even further, I recommend Kevin Davies' algo trading course, just because he takes this model that I teach you here, and then he kind of expands upon it into segmenting different parts of the market into different time frames, and then testing those in a way that has worked out for him. And honestly, it's worked out for me as well. But if you're just new to algo trading, it might be a little bit much to dive into a process that's that complex and advanced. And so here for this series, I'm just going to be backtesting all the way to the beginning of SPY, all the way or from that point all the way up to the present day. Even though that arguably is not the best way to do it, but for the sake of simplicity, that's what I'm doing. So let's go on to the second iteration. And this one I call the end day breakout pullback. So this kind of goes back to the US equities tend to trend in the long term, but mean revert in the short term. And there's several, I guess, theories or hypotheses as to why this happens. One could be that, okay, new news has entered the market, so the market is trying to break out to a new high, but investors are not yet positioned there. So the funds and whatnot, they need to reposition, and so there probably is going to be some kind of pullback that allows them to shift, maybe exit out of some of their adverse positions so that they can shift their direction, and then that's what causes the market to continue higher. So based on that, we're going to modify the entry rule. Again, I'm not going to modify the exit rule because I think that captures the idea pretty well. The entry rule is now going to have a change where it not only needs to make a new 10-day high, but it needs to then close in the bottom 15% of the range. And again, that's just the idea of, okay, for the market to head up, the investors need to reposition, and so they need to adjust their positions, which is probably going to cause some kind of pullback. And then what they're going to do the next day is then take the market higher now that they've adjusted position. And if this idea does not work, then I might try a few other ideas, but I will just tell you that this is the idea that does work and what we're actually going to code in the next video. But if this didn't work, there might be a few other ideas that I try for the entry condition before I just decide to completely abandon the idea. But this is what we're going to code in the next video. You're going to notice that it takes about 800 less trades. The net profit is about 20% less. However, the max drawdown went from like over 7% now to less than 2%. The average trade went from like $25 to over $86. The percent profitable is now higher than 75%, and the profit factor is like 3 times what it was. So this means this is a very efficient trading system right here. It's very efficient at capturing strong breakouts in the SPY. And I don't care that it took way less trades and the net profit's less, because again, what we're going to do in this series is we're going to take really strong strategies that are just good at what they're trying to do, and we're going to combine them together so that you have a portfolio of strategies that are just individually very good at what they do. And that portfolio is going to beat buy and hold. You don't need each individual strategy to beat buy and hold. And again, this is another area where I think algo trading is difficult, is everyone's just focused on, like, my first algo I develop, it's got to be really good and it's got to be buy and hold by itself. And it's like, well, no, ideally your algo is just really good at capturing the idea that you're trying to test. And if it proves that there is an edge there and it's really good at capturing that edge, that's all you need for that algo. And then you can just combine it with other algos that are also really good at what they're supposed to do, and then combine those together to create a system that is overall a much better trading system than buy and hold. So that's going to sum up this video. In the next video, we're going to actually dive into the Pinescript and actually coding it.